Okay. So chapter 23, talking about flexible budgets and standard costs. First of all, last chapter we looked at budgeting, right? And we looked at a master budget, correct? And then we're looking at a master budget. We looked at all the components of that master budget. And so for this one, we are concerned with the actual budgetary process. So talking about the master budget, we know that the purpose of the master budget is to plan for the future, right? And what's going to possibly happen in the future. Predict those levels. So looking at budgetary control, why is it important for us to have budgetary control? If you want to have control, that means that you want to do what? Monitor budgets, right? So that's what budgetary control is about. The actual budget reports are just going to have the important information that's going to compare actual historical results to what is particularly planned, right? So we got a couple of 4 different steps that are involved in the budgetary control process, meaning the process of monitoring. The first one is to develop the budget, right? Second is to compare actual to what has been budgeted. Third is to take action on that, because if you compare actual to what has been budgeted and you notice that the actual is higher in some areas than what was budgeted, you may need to take action on that. Or vice versa, if it's lower than what you possibly expected, then you may need to take action on that as well. And then once you take action, you want to set new budgetary plans, right? You may want to revise a budget based on that. So looking at the fixed budget performance report. Now we know fixed costs pertain to what? Constant, rarely or never changed, right? So what they're saying here with this fixed budget performance report is just it's a single prediction of what? Sales volume. In other words, this budget is fueled by sales volume, right? So it says a fixed budget also can be called static. It's based on one single predicted amount of sales or other measure of activity. More than likely, it will always be sales for the majority. Fixed budget performance report is going to show those actual compared to what? Whatever the budget was, right? Whatever you predict. So if you look at exhibit 23.2, they show you the fixed budget and then they have actual results. And then they have a column called variance, which is relatively new to you, but all it means is the difference between the two. So when we're talking about variances for budgets, we are concerned about whether or not a variance or a difference is unfavorable or favorable. Okay, and favorable and unfavorable will be potentially different for each type of budget. So if we're just looking at the fixed budget performance report, the favorable variance would just mean that the actual costs or the sales, right, are what?
Higher.
Higher. Higher than what? So it just means actual is higher than budget, right? But if we're talking about unfavorable, it's just the opposite. That means actual is lower than what has been budgeted. And again, that's all going to depend on whether you're talking about revenue or expenses. I'm on page 950 now, where it says budget reports for evaluation. So all we really want to know is, why do we care about variances? Why do we care about actual compared to budget? They've given you some potential variety of questions that may come along with that. For instance, it says, why is actual income higher than budgeted? What could possibly be the answer to that? If your revenue is higher than what you budgeted, clearly something happened, right? Production probably was relatively good, right? Good quality control, meaning you pushed or you produced out some good quality product and it increased sales because someone likes the value of your product. Are amounts paid for each expense item too high? We know that's a constant reason for budgeting. We know that's a constant thing in budgeting. Are our expenses too high? Where can we cut back? Where can we cut costs? Is manufacturing using too much direct material? We know there is a such thing as, what's the proper word? Wasteful, right? So with direct materials, because you're using those raw materials to produce products, there may be an employee or a couple of employees that are very wasteful. They may use more than what is really allotted towards each product. So you want to know if the factory or the manufacturing area is using too much. Is manufacturing using too much direct labor? Meaning, are you overstaffed? So do you have way too many people trying to produce production runs and don't really need that many people? Purpose of flexible budget. So we talked about fixed or static. Flexible just means a variable budget, okay? And that's going to be based on what? Revenues and expenses as according to what? Remember, fixed was based on a single prediction of sales, right? So that means the variable or the flexible budget is going to be dependent upon what? Actual level of output, which we know that's what variable costs are about, right? The more volume you produce, the cost will change, which makes them variable, right? So variable or flexible budgets are going to be the same situation. It's going to be predicted based off of the actual level of output. So if level of output is low, then the budget may potentially be low. If it's higher, the budget may be higher. It's also looking at a what if scenario. And if we're talking about what if, really what we want to do is do a budget on the high level and do a budget on the low level. Because if we do it on a high level, we'll always be wondering, well, what would happen if this was lower? You know, and the other way around. So that's why they call it a what if scenario. Now, if you're going to prepare a flexible budget, some things that you need to know. You must always assume, and it has it in the last line of that paragraph, assume that costs can be reasonably classified as variable or fixed within a relevant range. In other words, when you look at a budget, it shouldn't always just be total fixed. It shouldn't always just be total variable. There should be a combination of the two. It should be well evened out. It should also be within relevant range. And then it also says we express variable costs as what? Constant amount per unit sales or percent of sales dollar. So on any given budget, flexible budget, you may potentially see per unit, and you also may see percent of dollars. Okay? Now look at Exhibit 23.3 on page 951. This is an example of a flexible budget. And notice that when you look at the fixed budget, they did not have what on there? That fixed static budget did not have what that the variable budget does have, or the flexible budget does have. Say it louder, Ms. Taylor. So yeah, the variable amount per unit, for one, they don't have because it's a fixed budget. It's based off of what? One single predicted sales amount, right? So they don't have per unit amounts on the fixed budget. And then you also mentioned unit flexible budget for unit sales. And why don't you think they have flexible budget for unit sales on it? I just keep saying it over and over again because fixed budgets are based on single predicted sales amount, right? With a variable budget, because it varies and goes up and down on any given moment, you have to base all costs, variable costs, based off of the amount of what? We just read it. Units or output, right? So in this case, the reason why they have flexible budget for unit sales is because sales, if you notice, are increasing. One, they budgeted for 10,000 units. One, they budgeted for 12,000 units. And the next, they budgeted for 14,000 units. You know, that what if that I was talking about? They're doing things on the high and low side for what if. Because more than likely, the actual results are going to hit one of those targets, if not exceed it. Okay? So they have this budget here, and they're doing variable based off, and they're doing all of these different outputs based off of a what if scenario. Look at 952, because that's just a flexible budget we looked at, but the actual flexible budget report, performance report, is showing the same things again. What was budgeted, actual, and then the variance or the difference between the two. And it's also telling you whether or not they are what? Favorable or unfavorable. So these things where you see the actual and the budgeted and then the variance, these are called variance analysis. Okay? Variance analysis is where we are looking at price differences, we're looking at quantity differences. And the reason why we're concerned about that is because the purpose is to budget and manage and plan for the future. You want to make sure that you have a handle on how much your factory or manufacturer can actually produce within any given time period, however long the time period is, or however long the production run is. So they have standard costs. And when we say standard cost, what do we mean by standard? Normal conditions. So these are costs based on normal conditions. What do we consider normal? What's a normal cost? Standard repair is a normal cost to the equipment in the factory. What are some others? What they're basically trying to say here is the costs that happen under normal conditions. What are normal conditions in a manufacturer? They have to produce product, right? Normal conditions means everything's fine, nothing is broken, everything is functioning properly, enough labor is in place, blah, blah, blah. There is something you call management by exception, meaning it might be something that is not, you know, a part of the normal process, abnormal, right? What would be abnormal? Well, that's normal. Those things are normal. They don't normally happen. But I guess all we're trying to say is this. If we have normal standard costs, whatever you want to call them, those are things that we expect to happen, right? Normal things to happen, normal things to take place. Management by exception just means that we are looking for things that are really significant that stand out, right, in cost. So for instance, if your actual and standard cost, if your normal costs or budgeted costs are much higher than, much lower than what actually happened, to me, that's pretty significant. And you can't just justify sales jumping by 200% by saying, oh, we just produce quality product. Something had to happen that was abnormal for that to happen. Does that make sense? So if it's normal, your numbers will look normal. If it's an exception and something has significantly changed, that's going to ultimately change the conditions and the costs. Does everybody understand? Yes, no.
For example, just what the produce like this, like 10 batch and they produce 20. Is that they're trying to say maybe they have more employer or pay more money?
If a company is supposed to produce 10 and they produce 20, now that's a different situation because if 10 is the order, why would you produce 20? You know what I mean? if you produce more, what would that also increase? The labor, right? If we budgeted for you to produce 10, we budgeted for 10 labor hours for you to do 10 products. If you produce 20 out of that, you had to have spent a little more time producing that. But that's not out of the ordinary either. What we can say as an exception, and they don't really, well, yeah, they kind of do. Give an example. Standard cost. So it says providing services instead of products can also benefit from the use of standard costs. For example, while quality medical service is paramount, efficiency in providing that service is also important to medical professionals. The use of budgeting and standard costing is touted as an effective means to control and monitor medical costs, especially overhead. So what they're basically saying is that obviously it's normal for medical things to need attention, right? What they're saying is if one person calls the ambulance, should 5 doctors be in the ambulance? No, that's over efficient. And that's out of the norm. Kind of like when people go have surgery. It's normal to have 2 or 3 doctors on your surgery. But if you woke up and 10 people were around you, you'd feel, like something was really wrong, right? So we're talking about by exception and what is normally expected as opposed to what is not normal, but we put so much emphasis and attention on it when it's really not a normal or standard cost. Look at 954. They say identifying standard cost. Now, how do you think you're going to identify what's standard as opposed to actual? And they put it right there in the paragraph. All they're saying is they do a level of quality control, inspection, things that normally people would think take a certain amount of time. They're doing these tests to make sure that these things actually take that allotted amount of time. So some manufacturers may budget for, a 50-hour work week, but if it really only takes them 30 hours to make the product, why are you budgeting for 50? Obviously you budget above because you want to be safe, but that's too far above. Going from 30 to 50, that's a big difference, right? So they do these quality tests, quality control tests, to try to make sure that what is considered to be normal conditions is really what it is versus what we assume it should be. So cost variances, this is where it gets the most important. Cost variance and quantity variance. Page 955. They show you the variance analysis process, right? So the first part of the process is to prepare reports. Second part, analyze variances. Third part is to ask questions, get answers. Fourth part is to take action. So you're going to prepare the budget and the performance reports first, then you're going to do all the subtracting to look at the difference between the actual and the budgeted, and then you're going to ask questions about the budget, things that you see that are abnormal that jump out to you, and hopefully get answers, and then you're going to take action on how to fix those things, right? So the only thing you need to know, standard cost, actual cost. Actual cost is what has actually incurred, right? Standard costs are what? What we budget, expect, and we want to look at if they're favorable or unfavorable. How are you going to know if they're favorable or unfavorable when you're dealing with cost variances? If the actual costs are less than the standard cost, that means it is favorable. Okay? That's something you must know, and it's in that paragraph. If the standard costs are less than the actual cost, then that means that it's unfavorable. Everybody has it, right? Down at the bottom of 955, cost variance computation. Turn to 956. This is where the majority of it, we're going to do some problems, but this is where the majority of it basically lies. Exhibit 23.7 shows you the cost variance formulas, just basically reiterating some of the things that I've said already. Cost variance equals actual cost minus standard cost, where actual cost times, actual cost equals actual quantity times actual price, and then standard cost equals standard quantity times standard price. Did anybody print out the homework or know the homework problems?
I know this was on it. I can't remember the second one.
I'll be right back. Yeah. Okay, so let's look at quick study 23-1. Quick study 23-1. Beach Company sold 105,000 units of its product in May for the level of production achieved in May. The budgeted amounts were sales 1,300,000, variable cost 750,000, fixed cost 300,000. The following actual financial results are available for May. Prepare a flexible budget performance report for May. So if you go back and look on that page where we had flexible budget performance report, so you can see how it is structured. What do we start with? So we start with sales, and we need to have the budgeted and actual column, right? Budgeted, actual column, and variance. Okay, so for the sales, what was budgeted? 1,300,000. And what was the actual?
1,200,000.
What is the difference between the two? 25,000. And is that going to be favorable or unfavorable?
Unfavorable.
What's the next line?
Various costs.
Variable costs. And how much did we budget for variable costs? 750,000. What was the actual?
712,500.
And what's the difference?
37,500.
And is it favorable or unfavorable? Favorable. And then the next line we need to calculate is what?
Contribution margin.
Contribution margin, which is accomplished by doing what? Sales minus variable costs. So how much is it for the budgeted? 550,000. What about actual? 562,500. And variance? 12,500. Favorable or unfavorable? Favorable. What's the
How is it paid?
go back to those rules I told you.
But the actually more than that.
No. What makes it favorable?
You're gonna check if it's a cost or if you're not gonna see if it's a cost or sales. If it's a cost, you compare the budget and the actual, right? The budget of 750 and then the expenses are 712. Which one is less than? Is when we use less than what you support. We use and then it's valuable.
So
No, for the contribution margin.
Yeah, contribution margin, you compare the actual and the
So the actually more than
do you see that the actual is more than budgeted for contribution margin?
yeah.
Okay, fixed cost is the next line. How much did we have fixed costs? How much was actual? Was there a variance?
No.
No variance. What's next? Say it again.
You subtracted.
income from operation.
So what is the difference between the contribution and fixed?
250,000.
What about for actual? Variance, favorable or unfavorable? These are favorable. Actual is higher than budgeted.
Okay, let me ask you. I got it.
Oh. Quick study 23-2. Bat code makes metal baseball bats. Each bat requires 1 kilogram of aluminum at $18 per kilogram and 0.25 direct labor hours at $20 per hour. Overhead is assigned at the rate of $40 per labor hour. What amounts would appear on a standard cost card for bat company? So, how many bats are we looking at? How many bats are we concerned about? What's the quantity?
One,
Just one bat.
yeah.
And so for us to find the standard cost, what do we need to include? Direct materials. And what else? Direct labor and overhead. So if we're looking at direct materials, what do we need to calculate?
1 kilogram times $18.
Which gives us obviously 18, right? And then direct labor, what are we calculating? 0.25 times $20, which gives us how much? $5. And what about overhead? When we don't have overhead, what do we do? What do we use? Direct labor. So what are we calculating? How many direct labor hours did you have? Hours? 0.25, because that's what direct labor was, right? And at $40 per hour, which gives us what? $10. So total 18 plus $5 plus $10 gives us a standard cost of how much? 33? Good. And keep in mind, we're going to do the rest of the remainder of the chapter. We're going over some problems today. So that way you can start on your homework, I would hope, because I don't think it's due until the 8th. Let's do quick study 23-11. Quick study 23-11. Oh, change. First, quick study 23-10. Because that's where the information is coming from. It says Mosaic Company applies overhead using machine hours and reports the following information. Compute the total variable overhead cost variance. So now we got to list all of these things and we got to look for a variance between overhead. Now what I want you to do is look in your book back where it talks about overhead, and variances. Okay, budgeted versus actual.
Okay.
So what they're asking us to do here, they've given us all of these, the actual machine hours standard, the actual variable overhead rate per hour, and the standard. The first thing we need to find out is the actual variable overhead. Okay? How are we gonna find out the actual variable overhead? You got actual machine hours there, you have actual variable overhead rate per hour as well. So how are you gonna find the actual variable overhead? I hear you, Miss Taylor. Multiply what? How many? No, what was the amount of 4,700 times
Did you say actual?
actual 4,700 times, what was it? Which gives us what? $19,505. And then we need to also do the applied variable overhead, which you apply is another word of saying what? Standard. Or actual, no, not actual, budgeted. Remember with overhead, you can't ever just use whatever the rate is, you have to do the applied, not the incurred, right? So we have to do applied variable overhead, and that's the same as the standard that you see on that table. I don't want you to get thrown off. What do I calculate? 5,000 times $4 even. What's the amount? 30,000? 20,000. So in order for us to find the variance, we're gonna have to do what? Subtract. What amount did you come up with? $495. Now, is that favorable or unfavorable? Ms. Dallas said favorable. Explain to me why. It's favorable then. If your actual is less than the budgeted, it's favorable. If your actual is above the budgeted, it's unfavorable. In this case, actual was 19,505, which is less than 20,000. So that means that it's favorable. Okay. Quick study 23-11. We needed this problem in order to do that. Who has time? Who you keep up with time? So 23-11 says refer to the information from Quick Study 23-10. Compute the variable overhead spending variance and the variable overhead efficiency variance. So we're talking about two different things. I want you to go back to that page where we stopped on because that's going to help you to make it through it. We are looking for variable overhead spending and efficiency variance. Okay? So if we're looking for variable overhead spending and efficiency variance, what do we start off with? Because we're still comparing actual overhead and applied overhead.
On the same actual and the 4,000.
What do we start with? Look at those grids on where we left off in the chapter. Actual overhead.
Is it the same 4,700 or the?
I wanted you to actually locate,
558, 956.
yes, the was really 958
958.
because 956 is looking at price and quantity. 957 is looking at material price and quantity. But 958 is looking at what?
Actual cost.
Labor rates and efficiency, which is what they're asking you for. At the top of 958.
Spending variance and
At the top of 958, the problem is asking you for variable overhead spending and efficiency variance. If they ask for efficiency, you have to use the one that is at the top of 958. Okay? Starting with actual overhead or actual cost is what they have.
I just have a quick.
Uh-huh.
I was looking on page 959.
Uh-huh.
They have a spending variance and efficiency.
What page?
959.
Yeah, those are the same tables. They're just further back in the. It doesn't matter to me which
So
one
it's
you
the same.
use. It's the same thing. You can use the ones that look like they're in the appendix. It looks like in the back of the chapter.
Yeah.
You can use those, or you can use, and it looks like it's probably good to use those. They're all in one place. But that's up to you. Or you can use page 958. Yeah, either one. They're the same thing. So actual overhead, what are we multiplying? What are we concerned about? Actual hours and what else? Actual variable rate.
Yeah.
So AH times AVR. Looking at that problem, what numbers am I plugging in up here?
47 times.
47,000. I mean 4,750.
Times 415, which gives you what?
19, 545.
And then we also need to find what?
Efficiency.
Applied. You're gonna apply standard.
What about actual hours times
Yes, standard.
standard
Standard.
variable rate? Which is what?
4,700.
Uh-huh. Times
$4.
$4, which gives us
18,800.
18,800. And now we need to go over to what Mr. Ayiva was saying, applied overhead. And how are we going to get that?
5,000.
What's the actual equation? Standard hours,
Standard hours times
Standard rate.
standard
okay. What's the numbers to plug in?
5,000.
5,000 times
$4.
$4, which gives us what?
20,000.
20,000. Now, connecting these two,
That's from that 1,000
what is this variance here?
difference between here.
Yep.
1,000. Oh no. 705.
700 and
705.
705 here. And then what about between 20,000 and 18,000?
1,200.
1,200.
18,800.
Now, is that 705 unfavorable or favorable?
I think it's 11,000.
What's 11,800?
11,200.
Between 20,000 and 18,800?
Yes.
11,000?
It's 1,200.
Oh, no. How? I'm
I am too. 18,800 from 20,000 is 1,200.
yeah.
Okay, so was 705 favorable or unfavorable?
Yeah, it's going to be favorable because it's less than
Mmm.
Unfavorable.
Mmm.
It's gonna be favorable.
Why?
Actually,
What's the rule? What's the rule?
here we're talking about the cost, and you're gonna find out if it's less or more than.
Right, but what's the rule? Actual greater than standard, standard greater than, actual, what's the rule?
Actual greater than budgeted is favorable. Budgeted higher than actual is unfavorable.
Okay. So in this case, is our budgeted higher than our actual? In this case, from where I'm looking, actual is higher than standard. So does that mean that the spending variance is favorable or unfavorable? We're talking about the spending versus the efficiency. And if we're just talking about the spending or the rate variance, in this case, you're saying that it's favorable, but you can't tell me why. actual variable rate, standard variable rate. Which one was higher? Actual was higher. And according to what Ms. Taylor said, if actual is higher than standard, then that means what? Let's write this down this time when I say this. So that way we can have it clear. Favorable means actual is less than standard. Unfavorable means that standard is less than actual. We got it? Favorable, actual, less than standard. Unfavorable, standard, less than actual. So, I ask this question again. 705. The standard is lower than the actual, which means what? Unfavorable. However, the 1200, what's happening there? Is it?
It's lower.
How can you guys
Actually,
say that when where the 1200 is, they're measuring simultaneously the same thing? $4 and $4. Not different rate, different what? Output. Output. So, going back to what I originally said, the output being different means that what? This time standard is what?
Standard is
Greater than actual. So that means it's favorable or unfavorable?
It's
Favorable. Okay, so this is what I want you to see. Notice on this side of actual, we did not care about what?
Oh, this.
Hours. We didn't care, but we did care about rate, standard rate, actual rate. When we came over here to applied, we cared nothing about rates,
Oh.
but we did care about hours changing, right? This is how we were able to substantiate standard hours are greater than actual hours, and over here standard rate, or actual rate is higher than standard rate. Does that make sense? That's why I kept asking, well, how do you know if it's favorable or unfavorable? Because you really don't know what you're looking at. All you see is AH, SBR, QPO, whatever. You don't really know. But that's the way that you're going to be able to tell. But it doesn't stop here. What else do we need to do?
Take the difference again.
Because this is the spending. And this here is the what? Efficiency. So we now need to find the variance between spending and efficiency, which is what? What's the variance between those two? We had already calculated it.
495.
495. And is it favorable or unfavorable? Because what?
Our 1200 was lower, and the spending is greater than the spending.
Right. So our output costs were greater than what? reason why 495 is going to be favorable.
We using the higher one?
No. It's more simple than that. Yeah, you are using that, but I think the words throw you guys off. This is the same as standard. This is actual, right? So standard is higher than actual,
Yeah.
which means
495 is gonna be total.
you got it. All right. Let's do another. I know you're stressed out. It's okay. It will be all right. It really will. Next one is kind of similar, a little different. 23, quick study 23-12. Quick study 23-12. It says Farad Inc. specializes in selling used SUVs. During the first 6 months of 2013, the dealership sold 50 trucks at an average price of $9,000 each. The budget for the first 6 months of 2013 was to sell 45 trucks at an average price of $9,500 each. Compute the dealership sales price variance and sales volume variance for the first 6 months of 2013. So, what are we concerned with? We are trying to find the sales price variance, and how are we going to find the sales price variance? Which page do you use in your book to kind of guide you? This is sales price and volume variance. So which page do you use?
Price variance or quantity variance upon
What page?
956.
956. And so if we're going to use that guide as a guide, what columns do I need to put up here?
Sales, AQ times
Sales, what else?
actual.
Actual cost is what you said? Uh-huh. Is that it?
Actually, it's just actual.
Oh, and then the standard costs. The actual cost and the standard cost. Actual budget and the standard cost.
Actual, standard, and what else? Is that it?
We don't have sales.
A fixed one.
Y'all making it harder than it gotta be. I asked what columns do I need to write up here? Sales, actual, standard, which no, where did you get standard from? Why would you think it would be standard? It's flexible budget.
What page are we using?
I'm not sure what page you're on. I asked y'all what page should you be using as your
You said
guide.
956.
Miss Davis was calling them out. Sales, actual, flexible, and what else? Fixed, folks, fixed. Now, what page should you be using? Okay, now that's a whole other page. First you said 956, and I hear 952. Which one is it? No, 952 is not something you should be looking at either. You're looking for actual, flexible, fixed, look at 963. That might be a good one. What were the amount of units sold for each one of these categories? So 50 units, 50, you say? And then what? 45. And what were the prices for these units? Like for actual,
9,000.
what about flexible?
9,500.
Fixed?
9,500.
So when we multiply those,
Can I ask you a question?
yes ma'am.
How do you know 50 is for actual and 50 is
Are you looking on the same page they looking on?
fixed? Said is $23.
Right. And it said it. It said the dealership sold 50 trucks. And it said the budget for the first 6 months was to sell 45 trucks. So what we did was, if the actual were 50 trucks, that's what we put up there up under actual. And for flexible or variable, why would you know to use 50 units? Because it's what? No, it wasn't budgeted for 50. What happened with 50?
I'm sure it's.
Actually sold. So since 50 trucks were actually sold, we put that obviously up under the actual. And what does it say about preparing flexible budgets? And what we're trying to get to is why we would use $50 or 50 trucks for the flexible. What does it say about flexible?
When somebody said they're going to stay in that mountain.
Right, but why do we use the 50 under flexible? Why not use 45? The reason why we use 45 for fixed, obviously, because it's budgeted for that in the first 6 months. That was just the standard amount, right? But why do we know to use 50 units for flexible? I want you to read in the flexible section and tell me why we know to use 50 units. Read on page 952, under the paragraph, flexible budget performance report. And the, probably I say, 5th sentence, maybe, says we prepared this report after the actual volume is known. So because you know the actual volume sold was 50 units, you assume that it's the same for your flexible budget or variable budget. Does everybody understand? So that's why it's 50 for both actual and flexible, and then 45 because that was to be sold. That's what was budgeted for the 6 months. And now when you multiply the 3, what do you get here for actual?
150,000.
Flexible?
47,000.
Fixed?
427,500.
Okay. Now at this point, what do you do? You said 407,500?
No, 427,500.
So at this point, isn't it safe to do a price variance? What's the price variance between actual and flexible?
25,000.
25,000. What about between flexible and fixed?
47,500.
Is actual and flexible, is that 25,000 favorable or unfavorable? Okay, I hear one person say unfavorable. What do the rest of you say? And then I hear favorable. So which one is it? What's the rule? What's the rule? Actual less than standard means actual greater than standard means. So which is it?
Unfavorable.
Lord.
It's favorable. Actually, it's that's down. Okay. Now you're talking about sales. We gotta change it. You gotta change it, right?
In this case, the actual was lower than what
So what down?
what was budgeted. What has been budgeted. That is the key. In this case, actual sales are lower than what we budgeted. So that is clearly what? Unfavorable. Between flexible and fixed. The flexible is higher than the what? Fixed. Are we favorable or unfavorable?
Favorable.
Y'all need to write this stuff down. Afraid that you're gonna be on your test and you're gonna say, I didn't know what was favorable and unfavorable. I didn't pick one. Okay? You need to know the difference between the two. Okay, because I know that mentally you are fried. I just want you to write down these problems, and these are ones that I want you to practice on before we come back next week. Quick study 23-14. Through 23. dash 21. So 23-13, quick study through 23-21. Okay, and we're gonna go over all of those next week. So just work on them. Your homework is not due until the 8th, so we have enough time to finish out this chapter next week, do these problems, and get you prepared for your, what is your exam? The exam is Thursday? Or I thought the homework
Homework is due on 8th.
was chapter,
Exam
chapter, the next
Yeah, the
exam.
homework is doing that.
The exam is open on
Open
the
in
9th.
nine.
and
Yeah,
due
due on the
13th.
13th.
Okay, that's what I'm like, I know the exam is not due on the 8th, right?
So the homework is due on
The
8th.
homework is due on the 8th. The test is due on the 13th.
Yeah.
Did you get my email about the revised schedule? Yes?
Yes,
Why don't y'all check your emails?
I have it there.
If I email something about extra credit, everybody would read it, hands down. I send you something that's very important and very vital and critical. You need to read all your Angel emails. You need to try to make it a habit to log into Angel daily. Even if you don't do anything in there, you need to log in there, okay? I sent an email letting you know that the last exam, as well as the comprehensive project, those dates have changed because apparently someone changed the academic calendar. So what that means is that your project is due 5/1. The last exam is due 5/1. Your last day in class with me will be April 28th. So everybody's gonna go and check their email today, right? Angel, not student email, I don't care which one you check. The messages are on both. Check your Angel so that you can see that message. Go and print out the new schedule so that you will be on time. I will email out this week your comprehensive problems or comprehensive project, okay? And at first I was gonna make you present. I'm not gonna do that now. So you were safe. Miss Taylor is clapping because she's happy. But that does not change the fact that it still needs to be done. And it's so big that it needs to be done in a group, okay? So you still be responsible for doing a group effort on that, and only one person will turn it into me. But I'll email you out that this week. Everybody's clear, right?
On the comprehensive, when the Dropbox or, so we are going to have, as no presentation, we are going to have like Dropbox.
Uh-huh.
Okay.
It'll be a drop back box in
It will
there.
be in Word, but not
Right. Right.
Does this class bring?
Well, it's gonna be more than just Word. It might be Word and with some Excel spreadsheets too. What was your question?
I was just wondering, this class bring?
Unfortunately, we do not have spring break.